Okay, so continuing on with some of these evaluation type questions, you may be asked to evaluate whether the government has been successful in achieving their goal of domestic economic stability. So some key things you want to talk about there is that the government has implemented many policies which have been expansionary and will help domestic economic stability, and you can provide examples of any of the expansionary policies we've looked at in class, so the tax cuts, income, company, infrastructure spending, etc. But make it clear that they are also focused on paying down their debt and reducing the deficit, which has made it difficult for them to be too expansionary in the pursuit of this goal. So in terms of their ability to meet that goal, they have achieved some success. A lot of this has been due to factors outside of the budget, so the stronger overseas growth and the pickup in employment. But economic growth has increased to 3.1%. Unemployment's at 5.6%, so not quite within the target range. So that's the one that's outside the range still, but definitely moving towards that 4 to 5%. And the inflation rate's at 2.1%, which means that it's within the range and at the lower end at the moment. And the slight increase in inflation recently, it was below 2%, has been on the back of stronger employment data and the fact that the labour market's getting a little bit stronger, which is creating wage growth and also more consumption. So the government has remained committed to fiscal consolidation and budget repair. As part of their medium-term goal, they've implemented some contractionary policies, but given the fact that there's still spare capacity in the labour market and their desire to continue to accelerate economic growth, they've still implemented a lot of expansionary policies which should help to achieve domestic economic stability. Another question, the types of taxes. So there's three main types of taxes. So there's direct and indirect taxes. So your direct taxes, company tax, income tax, that are on incomes, and then indirect taxes on spending. But you also need to be able to define taxes in three separate categories: progressive, proportional, and regressive. So progressive tax means that the rate of tax individuals pay increases as they earn more. So the more you earn, the higher rate of tax you pay. Not just the more tax, even if it's a proportional tax system, you'll pay more tax if you earn more. If you're paying 2% of your income, you're going to pay more tax if you're earning $1,000 than $100. The key thing with progressive taxes is the rate of tax increases the more you earn. Examples, income tax is the main one, capital gains tax, because low-income earners generally don't have many properties or shares, they pay very little capital gains tax. Proportional taxes levied at a set rate. So if it's at 2%, the Medicare levy, for example, company tax rate's at 30%, it's a flat rate. You still pay more the more you earn because you're paying at a certain percentage per dollar, but they're at a flat rate. So Medicare levy, superannuation, company taxes, rich people still pay more of these, but at a flat rate of their income. And then regressive taxes are taxes that make up a higher percentage of low-income earners' salaries. So they're often indirect taxes, and things like the GST and excise taxes, even though they're at a flat rate, they make up a higher percentage of low-income earners' salaries. Headline and underlying outcomes. So the key thing with the headline is that it includes all one-off transactions, so future fund earnings and any net cash outflows for investing in assets would be included in the headline outcome, and the underlying excludes those. So if we look at our headline cash outcome of $27 billion, and then we've got future fund earnings of $3.3 billion, they're not included in the underlying deficit, so that would actually make the underlying deficit $30 billion or $30.9 billion. But there's also a cash outflow that won't be included in the underlying of $16 billion, which means that the underlying deficit gets reduced to $14 billion. So the underlying doesn't include anything, and therefore when there's money coming in for future fund earnings, the underlying deficit would be higher because it doesn't include that inflow, and when there's money coming out, the underlying deficit would be lower because it doesn't include that outflow. So if you look at these figures, you've got a headline deficit of $20 billion. If you've got future fund earnings of $5 billion, that would mean that if that was the only one-off transaction, our underlying deficit would be $25 billion because it wouldn't include this revenue. But we've also got outflows of $10 billion that didn't get included in the underlying deficit, which would reduce your underlying deficit to $15 billion. Doesn't include one-off cash flows. So if you're moving from a headline to an underlying deficit, what that means is that all cash inflows are not included in the underlying, so you actually need to add them to the size of the deficit, whereas cash outflows are not included in the underlying, so you actually make them deduct from the deficit. And opposite, if you're going from underlying to headline, any cash inflows will reduce the deficit. So if you've got a $20 billion deficit and it says you sold assets worth $5 billion, your headline deficit would become $15 billion. So that's kind of the one that's working in the right direction. In essence, that cash inflows are reducing, whereas cash outflows are increasing the deficit. The headline to underlying can be more confusing because you're working sort of the opposite way. Net operating outcome. Net operating outcome is just your underlying cash balance, not including infrastructure spending. So it's that distinction between current and capital expenditure. Current expenditure, day-to-day purposes. So in terms of education, teachers' wages, stationery, things that we're going to use up in the current period. Capital expenditure is more important because it has a long-term benefit in terms of our productive capacity. So that's your infrastructure spending. You're spending on overhead projectors. You're spending on built businesses that will have a long-term expansionary impact on the economy. Budget outcomes and growth. Okay, it's important you understand the short and the long-term impacts of both deficits and surpluses. So deficits can have a positive impact in the short term. The government's spending more than they're earning. That's generating more aggregate demand. There's more injections relative to leakages. The only negative for deficits in the short term is they can lead to crowding out. So higher interest rates that slow growth down. Surpluses are the opposite. In the short term, they have a negative impact. The value of leakages is higher than injections. That could be a sign of higher taxes or less government spending, which contracts economic activity. In the long term, however, it does have some positives. So in terms of deficits, the long-term impact can be negative. Deficits lead to a build-up of government debt, which can hurt our credit rating. That can make it hard to borrow and increase interest rates. Higher interest repayments lead to less money to spend in other areas, and the government may also be forced to implement austerity measures to try and pay back their debt, so they may have to raise taxes and cut welfare. On the flip side, while surpluses can hurt growth in the short term, in the long term they give the government's got more money to stimulate spending. So if we do experience a trough in the future, they've got more money to then stimulate aggregate demand and spending. There's less money directed towards interest because it helps us to repay our debt. Our credit rating remains high, and that helps to keep us getting access to cheap foreign loans. It also boosts international confidence in Australia, which creates more foreign investment. So deficit's good for growth in the short term, surpluses generally bad, and then the flip side on the long term where the surpluses are benefit for growth in our long term. Recent policy initiatives, you need to know some from the last two budgets. I'm not going to go into detail about them here. Just a quick snapshot. I'll send you this in class about some of the key policies. And same with 18-19. Infrastructure, the Urban Congestion Fund and the Melbourne Rail Network are the big ones. And then a range of policies to get us back to surplus. And for full employment, you can either choose the transition to workplaces or the support for older Australians. In terms of just articulating infrastructure and income taxes, there's some of the key things you want to talk about in relation to those two policies. So with infrastructure spending, short term it's about creating G2 and consumption spending. That'll help create jobs and growth, which will boost our productive capacity. And then in the long term, you really need to specify why it's good for boosting our ability to produce. So it reduces congestion, reduces bottlenecks, that leads to lower travel times, increased productivity, lower petrol costs, and that all those lower prices can boost both our willingness to supply and our overall international competitiveness. In terms of income tax cuts, remember that they're not only good for consumption and boosting demand, they can also create increased supply. So more people join the workforce, increase participation, and that helps to create benefits for our overall ability to supply as well. In terms of evaluations of policies, again, the strengths and weaknesses are really important. Some of the key ones, the short impact lag, the ability to target particular sectors. In terms of weaknesses, the long implementation lag, the lack of funds available at the moment because of our high level of debt, and the fact that it's often hard to stimulate spending when we're in a trough because of weak confidence and people not actually using those expansionary measures. So lower tax cuts may not stimulate spending. Okay, for an individual policy, strengths, again, infrastructure helps growth in both the short and long term. It has a short impact lag in terms of its impact on demand, and then it can benefit our international competitiveness in the long term. Your weaknesses can include the negative impacts on supply in the short term, the fact that there's a long implementation lag, it's hard to get the policies through the Parliament. Talk about key stakeholders that are affected, so it can be particularly unpopular because of lobby groups. And it can also conflict with other goals because it can lead to bigger budget deficits. It may also not have the desired effect because it causes crowding out, or it can lead to inflation as well. When you're talking about the difference between the implementation and the impact lag, be mindful that for something like infrastructure, they can actually have both in a way. So, for example, an impact lag, because it takes a long time to have its desired effect on supply, that's still an impact lag. After we build the road, or while we're building the road, it takes a long time to have its desired effect. So that can make it less effective because one, it's hard to get through Parliament, and two, it takes a long time to have its desired effect on supply. Just lastly, when you're talking about infrastructure spending, it can actually be classified as G2 or investment spending. If it's spending on private projects, so for example, sometimes the government lends some money for individual companies to build their own infrastructure. And the part of the reason they're willing to do that is because they can recoup a lot of those expenditures in the long term through tolls. So often projects are partly government funded and partly private funded, and the private sector is willing to do that because they get their money back through tolls. Thank you.